All right, we'll get started. I know some people will be joining us, but for those I haven't met, my name is Eric Walters. I'm the managing partner at Summit Hill Wealth Management. We're a boutique wealth management firm that provides financial planning and portfolio management to successful families. Thank you for joining us for our 2023 Outlook webinar. We'd like to take a look at what's happening with the economy and what that means for investors and their portfolios. We'll take a look at some of the key issues that I hear from clients, such as are we in a recession or facing a recession? What's the outlook for inflation and interest rates? And then what does that mean for markets and clients' portfolios? So if you are a client of Summit Hill Wealth Management, we want to thank you and are always available if you have questions. If you are not, we would be happy to take a look at your portfolio and offer any observations. And if you're an advisor to high net worth families, we'd love to get to know you and share thoughts and be a resource to you. So we'll get started. The first is our disclaimer. This is, our opinion and outlook. The second here is just our discussion agenda. As I mentioned, we'll talk about the economy, inflation, interest rates, markets, and then what does that mean for investors? Again, a little bit about us. What we do is really help successful families protect and grow their wealth. And if you're interested, you can contact us at info@summithillwealth.com. So let's get started. I think it's helpful to talk first about where we are in the economy. The market is not the economy, as we will talk about later, but it is a great starting point. And so you can see by the graphic here that we believe the U.S. is at the late stages of an economic expansion that we think really began in 2009 with interruption for COVID. You could argue that we kind of reset with COVID, but nonetheless, we're at the late stages here, and there's a real potential for a recession in our future. I'll talk about why I don't think we're in recession right now. That's one viewpoint. I don't think that's accurate. And also, there's a possibility for a soft landing, meaning a recession that is not too severe. We've had this happen in the past. Early 90s is probably the last good example of kind of a soft recession. So likely either, kind of a harder recession or a shallow recession, I would say later in 2023 or 2024. One of the questions I get from clients is, are we in a recession? We think we already are in recession. And I don't think that's accurate. This is a helpful graphic that just shows the difference between a late cycle and a recession in terms of key determinants. And you can see overall growth in late cycle is pace moderating, meaning growth is slowing. I think that's what will happen in 2023. I think GDP will slow. In a recession, GDP and overall growth is actively falling, and we haven't seen that yet. GDP has still been positive. Employment in a late cycle is tight, and job losses are beginning to rise. We are seeing that right now, and particularly in tech companies, they're kind of leading the pack. Often, they're usually the first stocks to go down, anticipating a recession, and they're usually the first companies to start laying people off. So we've seen that, friends in Palo Alto that are talking about job losses are piling up. But we haven't seen kind of job losses across the economy in a recession. So again, that's why I think we're in late cycle. Credit conditions are tight. The Federal Reserve is raising interest rates, and the yield curve is inflated and inverted. And that's where we are right now. And we haven't yet seen access to credit completely dry up in a recession. So, and also monetary policy, the Fed is tightening in a late cycle, and in recession, and this is key, the Fed actually starts to lower rates. And we certainly haven't seen that, and the Fed is adamant that they are not going to do that for a while. So I won't go through each one of these, but this is why I think we are still in late cycle, and I think we will be in late cycle here in 2023. And probably I would probably guess, late 2023, 2024, we may see these headlines and that indicate we are in a recession. So that's one reason kind of where I think we are. And I think we'll talk about that it has important implications for investors, that the market does not follow this same cycle. This is the economy. The market, I think, will be on a different cycle. But just a little bit about the economy. You can see global LEI, which is leading economic indicators. The leading economic indicators are called that for a good reason. They pretty good job of kind of pointing out where we are in the economy and what's happening. You can see they've gone negative here in the end of 2022, and also global manufacturing is contracting. So leading economic indicators plus a contraction in global manufacturing is a pretty good indicator of some sort of recession. Again, it doesn't mean that it's terrible recession, but some sort of recession, kind of on the horizon. And kind of a counterbalance to the idea that we'll have a severe recession is that unemployment is historically low. You can see, of course, it spiked in COVID, but it's still very, very low. And wage growth here is looking still pretty good, a slight negative at the end of 2022. But this is part of the reason why I think if we experience a recession, I think it will be kind of what they call a soft landing, meaning kind of a soft recession. Again, when we think about the driver of the US and therefore kind of global economy, it is US consumers. We just talked about wage growth coming down, but still, moving up quite a lot. And a lot of that wage growth has been in lower paying jobs. And so that's positive for a lot of people. Now, is that offset by inflation? Possibly, but it's still really positive for a lot of people. And then, when we look at the US savings rate, it's been unusually high with people, kind of at home, although still employed, and then kind of all the stimulus money. So the savings rate is, kind of gotten lower. And this is an indication that consumer spending will likely contract this year. Consumers have been, kind of living high on the hog because most people were employed through COVID, and then with enhanced unemployment benefits and travel and kind of discretionary expenses coming back slowly, people had a lot of money to spend. And now it seems like what's been happening at the end of 2022 is that people kind of maybe are spending past their cash and are dipping into cash, kind of like one final, gasp for, that trip or going out to eat. So consumer spending, we've already seen retail sales are starting to come in, and I think consumer spending will slow and go negative. Another indication of kind of late cycle dynamics, but nonetheless, consumers are still in pretty good place, but I think this points to what we'll experience this year. We've talked about it before, but the inverted yield curve has been an incredibly accurate predictor of recessions. This is when, rather than a yield curve that has lower short-term rates and higher long-term rates, which is kind of normal, if you borrow money short-term, you get less money. If you borrow money, or a lower rate, if you borrow money longer-term, you get higher rates in general. An inverted yield curve inverts that, meaning short-term rates are higher than long-term rates. And what that means is that investors, particularly bond investors, are expecting a recession. Now, historically, if the yield curve inverts for a period of days or weeks, then there's a real debate within the investment and economic community. Does that count? Is that a negative signal? And in general, you would kind of say no. A briefly inverted yield curve maybe doesn't have a great track record, but a consistently inverted yield curve does have an excellent track record. And you can see the graphic here. This is when this blue line goes below zero. This means the yield curve is negative. And then these gray bars indicate a recession. So you can see it's incredibly accurate. It's not perfect. There has been 2 times when it's inverted and there was not a recession within 18 months. But usually a recession follows, and usually it happens 4 to 21 months later. The average, depending on how you measure it, is about 12 months to 18 months, right around there. So the yield curve went negative last spring. Depending on how you measure it, whether it's the 2-year and the 10-year treasury or the 3-year and the 10-year treasury. But we can look at kind of late spring, early summer is when it inverted and just stayed inverted. So if we move forward a year or potentially 18 months, we would look at kind of historically, we would look at a recession happening later this year, maybe end of this year. My thought is late this year into 2024 is when we may experience a recession, and an inverted yield curve would be consistent with that. One thing I'll point out is that the yield curve is not inverted to the depths it was in the 70s and early 80s. And there is some correlation to how inverted the yield curve is and kind of how bad the recession is. It's not perfect. You can see it was kind of only slightly inverted before 2008, and 2008 was pretty bad. But there is some comfort that the yield curve is not wildly inverted, but nonetheless, it's a warning sign that recession is what the markets are expecting. Why are we, kind of thinking about this? It comes down to inflation. And historically, in late cycle economics, it's when inflation has started to get high, the Federal Reserve is worried about it and starts to raise interest rates. And if you go back a year, the Federal Reserve, was still at this point a year ago saying inflation, they think would be transitory. Boy, were they wrong. It was not low. It was not transitory. They got it completely wrong. So I think a lot of the issues that we are dealing with now and why the Federal Reserve has been so aggressive is their own mistakes. They missed inflation completely. They were too sanguine about it. They should have been more concerned about it. Nonetheless, I don't want to beat up on the Federal Reserve, but the data is clearly showing that inflation did peak in the middle of 2022 and is coming down. That was our thesis last year, that inflation would peak in the middle of the year. We can, kind of raise a hand and say, yeah, it looks like that's accurate. And it looks like that's probably going to continue when we look at wage growth is starting to back up. Unemployment, at least in tech stocks and probably, more broadly, is starting to head up. So if unemployment goes up, people will continue to pull back their spending, and then that would support inflation going lower. Now, will inflation go back to the 2% we experienced, after 2008, 2009? I doubt it. I think it could be, around 3 or 4%. But it's interesting to see that consumer and professional forecasters are kind of forecasting inflation in the 2s and 3s, and investors are as well. These are investors in bonds are expecting inflation in the 2s and 3s. That may be a little too low. I think it'll actually be closer to 3.5, 4, but nonetheless, inflation's trending in the right direction. It may not get quite as low as people are expecting, but still the trend is positive. Now, how is it going to get there? It's likely going to get there through higher inflation, higher interest rates causing a recession. This is the playbook that has happened in every single recession in, kind of modern history. The Fed gets worried about inflation and causes a recession by increasing interest rates. That's certainly what they've been doing. Now, here's kind of a dot path of what's been happening with interest rates. And if you've been following the news, what's been happening is that the Federal Reserve in 2022 has been raising interest rates very aggressively. And actually, the Federal Reserve has been raising interest rates probably more aggressively than they have probably in the last 30, 35 years. I think that's because they are kind of realizing that, they made some serious mistakes, and I think they have egg on their face. And so switching from being, too indulgent to the market to, I think, probably too harsh. But where the Federal Reserve and the stock market and the bond market are not seeing eye to eye is that the stock market is looking at the data that we just looked at and saying, we expect a recession, and we think the Federal Reserve is going to roll over as they have in the last, 20, 22 years, and they're going to lower rates aggressively. And the Federal Reserve, I've used the analogy in the past, the Federal Reserve is like kind of an indulgent parent who is finally all of a sudden, upset with their spoiled kid and says, no, I'm serious this time, you're grounded. And so the Federal Reserve, I think, is protesting really strongly that no, we will continue to raise rates and we will keep rates. Now, historically, the Federal Reserve has said the exact same thing until they abruptly lower rates. And just like at the end of 2021, when the Federal Reserve was saying, we think inflation will be modest, we think it will be transitory, and then into January 2022 and February 2022, they were saying, oh no, we still think inflation's okay. And then they abruptly reverse course, did a 180, and all of a sudden started raising interest rates. I think the Federal Reserve will probably do the same thing. I think they will, kind of moderate their pace. That's what they're talking about. And then as they see indications of a recession, I think they could move aggressively. So we had a question come in before, just about whether we could kind of trust the Federal Reserve. Do they have any credibility whatsoever? And honestly, I'm not sure you really should put much stock in what the Federal Reserve predicts or what they say. They have great data and they have really good people, but they are just people. And there's an institutional bias, I think, within the Fed to try and be careful. And what that often means is that they will anchor on the most recent data. And this is true for almost everybody. If you're a business person, you will tend to straight line forecast. If you had a good year last year, next year looks great. If you are, high earning executive last year, if you made a lot of money, you're going to think this year looks good. So it's a well-known kind of trait of humans, and kind of a thinking error that we tend to just anchor on what just happened in the last, 6 months, 1 year, 2 year, and just straight line it forward. And the Fed, unfortunately, is no exception. They tend to think, well, what just happened in the last year is probably what's going to happen in this year. And that can be true, except for turning points. And at the end of 2021 and 2022 was a notable turning point. The Fed missed it. I think this year will be a turning point in the sense that we will come out of this late cycle and go into some sort of recession. Again, I think it'll be soft, and the Fed will probably miss it. And in the Fed's defense, there is also a lag in data. Now, I think there are some private economists who have figured out how to do this. They look at rolling averages and they notice kind of turning points much better than the Fed does. But nonetheless, is it that the Fed is being malicious? No. Are they incompetent? No. There's a lag in data and they have a tendency to kind of straight line linear forecast. And I would say right now, add that to the fact that I think they are just straight up embarrassed that they made a mistake similar to what the Federal Reserve did in the 1970s. The 1970s, the Federal Reserve was also too sanguine about inflation and it caught them by surprise and they just could not get ahead of it. And I think the Federal Reserve, in a small way, made a similar mistake end of 2021, 2022. Could any of us do better? I'm not sure. But nonetheless, I think the market's kind of expectations, I think, are going to be more realistic than the Fed's. So what does this mean for investors? I think it means the Fed will continue to raise rates early in the year. I think at some point in the middle of the year, they will probably pause. And then towards the end of the year, they will probably say, oh, unemployment really is higher and consumer spending is down and whoops, looks like we did it again and yeah, maybe we'll start lowering rates. So I would think somewhere by the end of 2023 we'll probably start to see rates actually start to come down, consistent with what the market is expecting. Now, this is just a little bit more data just to show you about the difference in the Federal Reserve and the market expectations. When we look at the end of 2022, so this is just a few weeks ago, what is the Fed's kind of expectations versus the market? The Fed is in light blue, the market is in dark blue. And what's current, what's kind of happening. So the market's kind of thinking the policy rate's going to be lower in the year, that the market's also thinking inflation will come down. You can see 2.5%. That's what the market's kind of expecting. The Fed is at 3. It's kind of interesting. And that employment, it kind of maybe similar. But, in terms of, this is the Goldman Sachs US financial conditions, the Fed has been very tight, but that doesn't mean yet that they are easy. So there's this period of transition where the Fed goes from tight to slowly goes to easing conditions and to go back a phase. That's this idea of interest rates could start trending down, but if you're moving at 0.25% per movement per month, it takes a while to go from tight to easy. And so with a lag in data, with I think the conservatism, maybe embarrassment on the Fed's part, that's why we probably will go into recession, and the Fed will lower rates, but they won't suddenly go from a 5 or 5.5% rate to 0. They will slowly do that, which means we will likely enter recession, and then the Fed will kind of come along as the caboose. I think the main point I want to make in our webinar here, I've been talking with clients about this, is the point that the economy is not the stock market. And many of our clients are successful business owners, successful real estate investors, developers, and so forth. And what tends to happen is that they read the news very carefully, and they are very familiar with all the data I just went over. And normally their thinking goes something like this. Well, things look like it's going to be pretty poor in the economy. Therefore, I'm going to hold back and I'm going to get defensive and I'm going to stay defensive until things look good in the economy. And the problem is that this is a great way to completely mismanage your portfolio because the stock market looks ahead about 9 to 12 months. And this graphic does a great job pointing this out. And if you try to invest and align your portfolio based on what the Wall Street Journal headline is for the economy, you will completely mismanage your portfolio. And I say that in all love and humility, but it will lead you astray. And here's why. I would say in the end of 2021, early 2022 was the top of the most recent stock market cycle. And you can see, this graphic here shows the stock market's kind of going down, even though the economy is doing pretty well. And that's exactly what happened last year. The economic data was good for last year. Unemployment was low. Consumer spending was positive. Industrial production was strong. And so if you were looking at that data, you would probably think, why is the stock market down so much? Well, it's because the stock market was kind of expecting a recession here, this right here. But at a certain point, the stock market has fully priced in a recession, even though it hasn't happened. And the stock market's looking ahead. And I think what's going to happen is at a certain point, I think this year, the stock market will move from moving down to starting to move up, even though the data on the economy is getting more and more negative. And I'll say, in my experience, 17 years managing portfolios, this is the one pivot point that I would say trips up 90% of investors. And what happens is the stock market starts to move up and investors say, that's bananas. The stock market's crazy. We can't trust the stock market. This is a dead cat bounce. If I had a penny every time I heard these phrases, I would be a wealthy man. When what's happening is that investors see the data is getting worse and worse and worse, meaning unemployment's getting worse, layoffs, Ford is, then people are lining up and things are getting worse and, But the stock market's moving up. And the reason why is the stock market's looking ahead to eventually that recovery phase. And usually this period in the stock market is plus 30 or 40%. It's usually a strong move, and it happens usually over kind of 6 to 12 months. But if you'll notice, it happens before the economy really bottoms out. And by the time that you start to see the economy start to move up, the market's already priced it in and is well on its way, like plus 30, plus 40%. And a plus 30 or a plus 40% on a portfolio is a lot of money. So if you wait until unemployment peaks and starts to come down, or everything looks great, or GDP is positive, you have missed a major move in the stock market. So what I did is I took these, stock market and economic kind of waves here and tried to put my outlook for the next few years. And this is risky for me to go out and say, here's why things are going to happen in 2023 and 2024. But I'm trying to base this on data that I'm seeing in moving averages for these key economic indicators, like manufacturing, like the leading economic indicators. And I don't claim to be some stock market timing genius, but I think the data is kind of showing, in 2022, clearly we had a stock market, kind of peak and then negative. I think we could go negative some more in the stock market this year. I wouldn't be surprised based on historical averages if it's kind of a negative 10 or 15%, that'd be averages. But at a certain point, I think we will hit the bottom this year. I wouldn't be surprised if it's around the middle of this year, maybe into the third quarter. I think we'll bottom out. And then I think we'll start to move up, even though the economy is still getting negative all throughout the year. And then I think we will kind of trough and maybe enter a recession here, fourth quarter of this year, first quarter of this year. And I think at the same time, the stock market's going to be confounding everybody and looking forward to, which is, I think, probably economic growth in 2025. So you can see my descriptions here. I think, in 2023, economic growth will have peaked and will be slowing all throughout the year. We may go negative at the end of the year, somewhere right here. I would think like fourth quarter into first quarter, we could go negative. Again, I think it's shallow. I think the stock market will bottom this year and eventually go up. Does that happen in March or does that happen in August, September? It's too hard for me to say. I don't know. We need more data, but at some point we're going to bottom. And I think where the conservative investors might get caught flat-footed is that the market has these really strong movements up in bottoming. And if you're waiting to see that, it could be middle of 2024, or excuse me, middle of 2024, and you could miss a big move. Now, some investors say that's fine. I don't care at all. I just want to be conservative, and that's okay. But just be aware that these moves are not like a 5% move. Historically, they're a 30 or 40% move. And usually there's a lot of regret here and when the market's like, wow. And usually what happens is there's this kind of fear of missing out. The kind of FOMO comes in full effect here, where the market's like up 10, up 15, up 20%. And if you are in cash or bonds only, and you're like, oh man, maybe I guess it's okay. And at a certain point, investors kind of go, well, okay. And if you take this back to 2008, 2009, this year here would be 2009, right? Because the economy was completely crashing, but the market bottomed in that April-May period of 2009, and then was up really strongly in 2009 and in 2010. So if you want to use an historical kind of analogy, that this would be 2009. And in 2009, and I mean, I was managing money at that time, it was like impossible to get anybody to rebalance and believe that the market would ever bottom. And even at the end of 2009, people were like, I don't know. I think the dollar's going to collapse, and we're going to hit hyperinflation. And so it's understandably from a psychological standpoint that people would look at this and say, I don't know. This could be a terrible year. The other shoe could drop. That's normal. And this is why investing is so hard. If it were easy, if you just invested according to what was happening with unemployment, this would all be easy. It's not. And looking ahead is hard. And the market, at the end of 2022 and 2023 has been trying to anticipate, when is the bottom happening? Is it January? I think we have a little bit more pain to go through, but nonetheless. So this is my outlook. This is my reminder. Don't invest according to what's happening in the economic news. It's going to get worse all year, but at some point, I think the market's going to bottom and turn around. Just briefly, I want to be thoughtful to time here. Looking at full year 2022 performance, it was a challenging year, but it was really helped by the fact that the fourth quarter was actually a pretty good quarter for a lot of assets. Commodity, gold, high yield bonds did well. But look at this, international stocks up 17% in one quarter. Wow. That's amazing. Bonds did pretty well. And then also a number of stock categories did quite well in one quarter. And so this is a little microcosm. When the market starts to turn, you get returns like this in a period of weeks. And this is just the fourth quarter. The beginning of the fourth quarter, October into November, was not great. This was probably mid-November into the end of the year. But look at the returns, 9, 6, 15%. Eventually, I believe this year, we're going to get returns like this over a period of weeks, and then it will probably pull back, and then they'll just be sustained upwards. So we'll probably start the year kind of -15, -20, or -10, -15 would be my guess from current points. But eventually, we're going to have a few weeks that are just like fourth quarter. Bam. Now, it's possible that we could have put the bottom in and that these numbers are going to keep going up. And I don't think that's going to happen. I don't know if we're fully priced into recession, but this is a good example. If you are an investor, what can happen a pretty short amount of time when the market turns. Now, historically, when the stock market is afraid of recession, but there isn't a recession, the stocks have gone down about 22% and profits go up. If there is an actual recession, stocks go down 35% and earnings are down. So if we go into recession, this is why I think we could see another -10 or -15%. We would be kind of fully pricing in some sort of a recession if I'm right that it's not too serious, meaning unemployment doesn't go up too much. Maybe unemployment goes from 3.5% to 7%. Historically, that'd be pretty mild. It may not go down a full amount here, but that's why I think there maybe is a little more pricing in that needs to happen, particularly on profits, because that's a key part of a recession is that corporate profits go down, and that means earnings often go down, and then what's a fair price on the stock market is kind of up for discussion. So this is why I think we may need to price in some more this year. I see we got a question. Let me pause and answer that. What behind that? Oh, so the question is, what's going to happen to markets, and how do we respond if Congress doesn't raise the debt ceiling in a timely way? That's a great question. The shenanigans that are going on with the debt ceiling have happened in the past. If memory serves, the last time this happened was 2011. Congress could not deal with it. The Treasury kind of started extending out and going into, emergency situation. I think we could go into a situation like that, and we could see a government shutdown. Now, I think it's important to know that government shutdown applies to what I would call kind of discretionary government expenses, kind of key expenses continue on with the government. And I do not think that the US government is going to default. And during this time, the market did bounce around a little bit, but it did not crash. There was a downgrade. S&P did downgrade the US from AAA to AA, still one of the highest. But I don't think we're going to default. I think we'll probably have shenanigans like 2011, but I don't think it's anything that investors should pivot around. I don't think that our elected leaders would be so stupid to literally default. I know people can say a lot of negative things about our elected leaders. I'm not going to get into it, but I don't think that'll happen. So I don't think it's something that investors should kind of reposition their portfolio. I think just expect like 2011 that it'll be headline news for a while, and then they'll come up with something and then kind of go forward. So thank you for the question. I don't think it's something that we should reposition portfolios for. Now, some clients are, kind of more technical and have said, well, Eric, I appreciate that you kind of view things from an economic lens and that you're kind of looking at the market, it's kind of looking forward through the economy, but is there anything else that can help us see if we've put in a bottom in the stock market? And there are about 6 what are called technical indicators. This is indicators that are just within the stock or bond market that have been associated with major bottoms, meaning the stock market has gone down at least 20%, and these things have consistently kind of indicated we've reached a bottom. Now, 4 of them we have hit last fall. 2 we have not hit, but have been pretty close. So if we just look at kind of the stock and bond market itself, does the stock market and bond market kind of indicate kind of extreme selling or extreme fear? I won't go through each one of these, but that's kind of what each of these look at. Yes, 4 out of 6, and the other 2 were pretty darn close. It doesn't mean, of course, that the stock market can't go down more as we get more data about recession and prices and corporate profits. Those are the wild cards over the next 6 months. Honestly, what's going to happen with consumer spending, unemployment, corporate profits? If you want to pay attention to anything, pay attention to those. But the fact that we hit these indicators kind of indicates that we are in bottom territory. Now that could extend into the first half of this year, as I expect, but nonetheless is, I think, a positive sign that we're probably closer to a bottom. So we talked about this in our October webinar. How can investors respond? My advice for this year is, invest like a scientist, not a caveman. And, I say that again in all love. Many investors kind of judge things based on just the value in their portfolio, right? Did last month's statement go up? Great. If it doesn't, this is bad. If there's negative news in the Wall Street Journal, that's bad. But I think we can try to look at the data and just be a little more nuanced about it. We've already looked at data about where the economy is right now. There's a real risk of recession, but I think it'll be shallow. We already looked at the fact that the stock market is aware of all this and is already looking ahead. So the stock market is aware of the federal funds rate. The stock market's aware of inflation. The stock market is aware of the risk of recession and is pricing in a good amount of it. Maybe not all of it, but a good amount of it. So we've looked at that data. Other data that I always think is helpful is the fact that historically the stock market has been up 75% of time. So if you just had to cover your eyes and throw a dart and say, what should I do? Be invested, right? Because it's not like slightly up 70% of the time, it's like double digits up. And that's, as I mentioned, just in the fourth quarter, we had double-digit returns on some assets. I think at a certain point this year, we could get a few weeks where all of a sudden it turns around and investors are like, what just happened? The stock market's up 20%. It happens pretty frequently. So, if you had to bet on good returns. And also just look at the history of the stock market. I share this at almost every webinar. If you invested $1 in the stock market in 1970s and horrible things happened, inflation, major market crashes, wars, more market crashes, terrible things, potential default in 2011. And then your dollar became $80, which is what, 40, 50 years later. That's kind of what the stock market does. Now, it's not fun to go through. It's not pleasant to experience, but this is what the stock market does because companies have to, or everyone gets fired and they go bankrupt. So companies have to adjust. Historically, the stock market has responded really well. Shows a blended portfolio of 60% stocks, 40% bonds after major crises, after major crashes. You can see on average, 1, 3, and 5 years, these returns are up a good amount. And so if last year, was your kind of bad year, then you would say, well, actually 1, 3, 5 year returns looking forward historically are actually pretty good. So we've endured discomfort last year. There may be some more, I think we've endured most of it. But if you're looking forward as an investor, you should actually expect really good returns. And it's not time to be super conservative and go to cash. The data would say, actually, you've got a pretty good chance at pretty good returns. This is kind of a mess of a chart, but it just shows, looking back, the best performing asset class each year. And you can see, for example, this dark blue is fixed income, this light purple is emerging markets, and so forth. But this white box shows that 60% stocks, 40% bond portfolio, and how it did through a terrible year like 2008, how it did through great years, like in the kind of mid 2010s, and then how it did in 2021 and 2022. And a diversified portfolio is never the best performer, but what's key is it's never the worst performer. It also, through a difficult, kind of 12 years, when you assume 2008 major drop, 2020 good drop, and then recovery, and then 2022 difficult year, it managed an annualized return of 6.1% per year, and it was in the lowest volatility. So diversification and just sticking with it actually works. Through 2008, 2020, 2022, it works. Now, you're never the best performing asset class. If you want to try to guess which year small caps can do the best and emerging markets going to crush it, but it's also never the worst. You never experience these really, really negative returns. Like, example, in 2008, the diversified portfolio was down 25%, emerging markets were down 53%. So what does this chart look like for 2023? I don't know. That's the interesting thing about investing. But the beautiful thing is that you don't need to know. You don't have to get this right for 2023. You just have to pick what's the right mix of stocks, bonds, and other assets for you, and stick with it, and you will navigate through. And some people call it muddling through. That doesn't sound very exciting, but it does when you think about 6.1% per year through a period where there were 3 major market declines. And I'll emphasize this, particularly if you are retired. A lot of people think about, in retirement, we need to be super conservative. We basically can't take any risk. Well, most retirements are projected to last 20 or 30 years. A diversified portfolio can get you through and also help you with risk-adjusted returns. So that's one of the beautiful things. The other observation I'll make is that international stocks are unusually cheap. And they have been really since 2021. But this is the valuation of international stocks relative to the US. It's 2 standard deviations. If you remember your statistics, that's notable. 2 standard deviations below. Their dividend yields are higher than US on a relative basis. Now, the US dollar has been really strong because as the US has increased interest rates, money has flocked here from the rest of the world. But if I'm right, and the kind of the Federal Reserve is going to probably kind of flatline interest rates and then lower them, that strength of the dollar is going to go away. And eventually, when there's kind of more stable, international stocks are going to do pretty well. Now, you may remember in the fourth quarter, international stocks were up 17%. Not bad. Now, international stocks are the perennial disappointment for US investors. US investors are always being told, like, emerging market stocks or Japan or whatever is about to break out. Now, there are periods of time, multiple years, where international stocks do well. And I don't know when they're eventually going to turn around. You can see, in the, kind of zeros to 2008, they were kind of expensive. So here's a period where international stocks did well. But it's one observation for investors. If you want to be contrarian, look at international stocks. Who knows when it's going to turn around, but eventually the strength of the dollar will fade, and eventually this valuation differential will correct. So what does this all mean for investors? The first thing is prepare your own financial plan. Understand what your time horizon is. What are your cash flows? What are your vulnerabilities? Have you stress tested your financial plan for a major market crash? Have you considered long-term care? Have you considered the potential loss of your job? Have you looked at a lower or higher value of your business and what that might happen? So prepare your own financial plan, look at your own risk tolerance. And I can't emphasize that enough. It's different for everybody. I already mentioned focus on the long term. The data would support this. And then to get a little more tactical, this year, be ready for volatility and upside. Normally, when people like me say be ready for volatility, it means things are going to be bad and it's going to be bad and, go get a drink and just don't read the news. But I think be ready for volatility and upside. If I'm right about where we are in the economy, the market's pretty soon going to price in all the bad news and be ready for good news. I think if you are holding risk assets like stocks, I consider you should hold. It's a good time to rebalance because often you'll kind of be adding to them. If you want to get more aggressive, you could add to international stocks. And then I talk to our clients about diversifiers. We use private equity and hedge. Both of those in general did really well in 2022. I can't, get specific, but they were positive. We also use structured notes, which are packages of derivatives that give protection on the downside with enhanced upside, either an upside on the stock market or enhanced income. Those also did well. And then finally, we also used managed futures as a replacement for bonds. Those were up kind of 3 to 5%, which is a lot better than bonds, kind of -12, -15%. So if you are an investor and you are frustrated or you are looking for ways to both get upside with some protection, those are some tools we've used for clients and happy to talk to you about those. And then if you have sold a business, if you have had cash on the sidelines, this is a great year to apply dollar cost averaging. And dollar cost averaging is just when you take the amount of money you'll be investing and break it into pieces, maybe a third, 1/6. If you're really conservative, you could do 1/10, and just put some to work kind of on a regular basis, maybe monthly or quarterly. And what that does is it pushes you to invest when your instincts are, I want to stay on the sideline and wait till everything looks better. So dollar cost averaging pushes money into the stock market and bond market and alternatives when you might not. And then it also gives you dry powder, if I'm right, and there's some volatility, AKA some potential losses, that you can take advantage of potential lower prices. It's one of the few ways people with cash can kind of win no matter what. And what I mean is, let's say the stock market just goes straight up this year. Well, at least you put some money in early and took advantage somewhat of it. Let's say the stock market goes down another 20%. Well, at least you didn't put all the money to work right away, and you took advantage of these lower prices. So when there is fear, when prices are, down but still volatile, and we're in these kind of transition zones, dollar cost averaging is one of the best things you can do. I'll just kind of point out our philosophy is, there's a lot of things that matter in investing, and I've listed them here. And the things that you cannot control are a lot of things we just went over: the economy, stock market, inflation, interest rates, and so forth. But the things you can control are more important. You can control how you invest and stay invested. The most important thing in retirement is your own expenses. You certainly can control that. You can control the timing of Social Security and things like IRA to Roth conversions. You can control proactive tax planning to try to limit legally the taxes you pay. You can, control rebalancing. You can control all these other things. And of course, most importantly, you can control how you take care of your body and the relationships and hobbies you invest in, which ultimately, when we're all 85, God willing, and on the porch, we're going to focus on our relationships, and you can focus on that. So I like to think that investing should drive you towards the things that matter most, like your relationships, like your health, like your hobbies. And, we spend a lot of time talking about the economy, stock market, inflation, and it's very important. But ultimately, the things you can control are, I'd say, as important or more important. Here's an example of a financial plan. We like to stress test financial plans and thinking about things like major market declines right when you retire, or a long-term care needs when you are 85 and you're not earning any money anymore. This is what you should start with. You should start with your financial plan, understand your own risk tolerance and your own kind of cash flow, and then start thinking about how you should invest. Start here, and then this is your anchor for your portfolio, and this is kind of your North Star, where am I headed? What's the long-term goal? The long-term goal is not to beat the S&P 500 every year. Who cares if you beat the S&P 500 if you're not in good health, or if you don't have relationships with your kids and your neighbors and enjoying hobbies? Who cares about the S&P 500? Now, I care about the S&P 500, but this is just an example, an illustration of your kind of best life, as I think Oprah would say. Let's focus on that, and then investing is put in its right place. I always like to say, in the short term, returns are very unpredictable and volatility is high. But in the long term, volatility goes down and returns are very predictable. And what does that mean for investors? What's going to happen in the next month, quarter? I don't know. But over 5 years, 7 years, 10 years, I'm pretty sure how portfolios will perform. And that's what matters for investors, those long-term returns. Stick in it for the long-term returns. The data backs me up. If you look at rolling returns, rolling 1 year returns, rolling 2 year returns, when are they consistently above 90%? It's right around 5 years. So if you focus on a 5 year rolling return, 90% of the time, that return has been positive. So again, just kind of lengthen your timeframes in your mind from how did my portfolio do last 2 weeks or fourth quarter or 2022. Think about how did my portfolio do over a rolling 5 year, and how should it do over a rolling 5 year. If you are a younger investor, you should be aggressive. If you are in that zone of preparing for retirement or in retirement, these timeframes really help. We use things like cash reserves and individual bonds to give buffers to those approaching retirement, in retirement. If you're doing that already, hopefully that's giving you peace of mind. If not, let us know. We're happy to give you kind of a second opinion on it. That's what we want to talk about today. 2023, I think, will be volatile as we see the economy kind of slowing down. I think the stock market will see that and eventually pivot, but that's what we want to talk about. Let me pause, and I see we have some other questions. So there is a Q&A button that you can feel free to type in your questions. Let me just take a look. All right, so we've got two questions. One is, thank you for the explanation on the timing of like a recession. I mentioned the recession may be shallow. What do I mean by shallow? So by shallow, I mean that I don't think unemployment will go up to something where it has a significant impact on the economy and consumer spending. And that usually would happen, with unemployment somewhere like 10 to 12% and up. If unemployment gets that high, you have a lot of people unemployed, and you have a significant pullback in consumer spending. And then you have a lot of businesses that have a real problem with revenue and profits and go out of business. So when I say a recession may be shallow, I think about some of the recessions we've had in the past where unemployment might go from 3 to 4% to maybe 7 to 8%. Historically, it's been a shallow recession because, yes, you have people that are becoming unemployed, and that's difficult at an individual level. But if we look at a macro level, it's the level of unemployment is not so serious that it has a widespread impact on company earnings, both public and private, and company profit, and then huge bankruptcies. So I would think we may experience this kind of historical experience of unemployment kind of 7 to 8%. And if you flip that around, you can say, well, we might go from the percentage of employed people from 97% to the percentage of employed people to 93%. Okay, 93% of people aged 18 to 65, they're looking for a job, who are unemployed, who are employed, still sounds pretty good. 93% employment. That's what I mean by a shallow recession. You could say, well, yeah, I mean, it may affect some things. Certainly tech companies, I think, have gotten kind of out of hand in terms of hiring. They probably need to adjustment, but that's a shallow recession. And another way to think about a shallow recession is its duration. It can be not only how many people are unemployed, but how long it lasts. And so I think this could be shallow in the sense that we may only have 2, maybe 3 quarters of negative or low growth rather than 8 quarters of negative growth, which would be pretty serious. So thank you for the question. A second question there is bonds and the performance of a 60% equity, 40% bond portfolio. The question here is that bond performance last year was historically bad, what's the outlook for bonds now? And this is a great point. Last year was one of the worst years for a 60% equity, 40% bond portfolio. And for those of you that don't know, that portfolio, 60% equities, 40% bonds, is viewed as kind of a cornerstone portfolio for people as a kind of a more moderate risk tolerance. It works really, really well for people in retirement. It's also a benchmark for a lot of people to kind of compare portfolios, between different investment firms. And last year was one of the worst years for that portfolio because bonds were down, kind of 12 to 15%. So that was horrible. It was a bad year. Bonds did not give the positive performance they normally give when equities are down. The outlook for bonds now is significantly better just because bonds have now priced in higher inflation and the likelihood of high interest rates. So, I can create a bond portfolio for someone with an average maturity of 4 or 5 years, and they can get about 4.5 to 4.8% per year. That's actually pretty good. Now, if inflation starts to come down to 4%, you're still getting a positive net return. So I think we had a terrible year for the 60% equity, 40% bond portfolio, but I think it's actually looking pretty good looking forward. It was a difficult transition, but I think actually looks pretty good. I did mention to a client this morning that for years I have been reducing my estimates of how well stocks and bonds will perform because both stocks and bonds were expensive. This year may be one of the first years in about 5 or 6 years that I will actually increase my expectation on how stocks and bonds will perform over a long period, 10 to 15 years, because of current valuations. And that goes to the question about bonds. We're looking at longer term bond returns actually better than they've been in quite some time. And with equity prices down, I will probably likely slightly increase my expected performance of stocks and bonds, and therefore the 60-40 portfolio. So great questions. Thank you. Another question, is there a correlation between the exchange rate and the stock market? With the dollar losing value, will we also see lower exchange rates, weaker dollar when traveling in 2022 or 2023 and 2024? Yes, there is. And so in general, as interest rates in the US go up, it generally attracts money from around the world. And then it also, kind of forces other central banks to raise their their interest rates. Eventually, what happens is the Federal Reserve lowers the interest rates during a recession, and other central banks will also lower their interest rates, which usually investors will still stay invested in the US during a downturn. But eventually, as the stock market starts to recover, investors will start to kind of breathe a sigh of relief and assets will move away from the US and go international. So I would think this year, if I'm right, if interest rates kind of flatten and start to go down, investors will probably stay in the US for those relatively higher interest rates. And also because the US is a safe haven. But at a certain point, I would say, later into 2023 and 2024, if I'm right, if the stock market's starting to move up, and particularly international assets are starting to move up, investors will kind of slowly move assets out of the US and into more risky international assets. And that would mean exchange rates would more normalize. The dollar would kind of lose value. And then for personal impact, yes, you would likely see higher exchange rates for travel in late 2023 and 2024. There's a little bit of a lag there, but yeah, I'd say probably a better chance in 2024. All right, another question. These are great questions. What are the risks of global debt liquidity crisis, especially in light of significantly higher interest rates and the need to roll over massive amounts of corporate and sovereign debt? So it's a great question. As the Federal Reserve has raised interest rates, they have stopped buying securities. And, in 2008, they were buying bonds, treasuries. And then in 2020, they were buying bonds and corporate bonds and junk bonds. And then other central banks were as well. And so what that did was injected a huge amount of cash into those markets. And I think seriously distorted those markets. And then as central banks have raised interest rates, they've stopped buying those assets. So what that means is, I think that accounts for why the third quarter in 2022 had such bad performance in those assets, because the stock and bond markets were basically accounting for the fact that their big buyer, which was the Federal Reserve and other central banks, was gone. So I think, I don't think there'll be a debt liquidity crisis in the sense of the central banks no longer purchasing debt instruments. I think also the question has to do with sovereign debt. And so if we also look at the risks of countries around the world, including the US, are borrowing like drunken sailors, is there a problem for those sovereign countries to borrow and higher interest rates? That's a good question. So when countries are running an annual deficit, they have to finance it, and they do that by issuing bonds, and they have to pay the prevailing rates. So the US government and countries around the world are now paying significantly higher rates for that. And so their interest cost per year is much higher. But we are not seeing any stress in those markets. We're not seeing investors boycott an entire country or something like that. What investors are doing are basically saying, yeah, we'll lend you money, but it's no longer at 1%, it's at 4%. Or for other countries, it might be at 6 or 7%. What does that do? It likely will create some problems for those sovereign countries where they will need to pull back on spending. They will need to kind of work on balancing their budget. And usually there's a delay in that. They don't do that right away. But what those sovereign countries will eventually need to do, and the US may be an exception, we seem to be able to borrow without a problem, but other countries more likely will need to kind of pull back on spending to account for that higher interest cost. But I don't see any kind of sovereign debt crisis like 2012, when everyone thought that the Eurozone was going to go kaput. And Portugal and Spain and Italy and Ireland were all going to go bankrupt. I don't see any signs of that happening. And I think countries would do what I think is probably pretty normal, which is they'll start to pull back on expenses. Eventually, they'll kind of say, well, we need to have a little bit more balanced budget. Another great question here. How will the 2024 presidential election affect the market, and how? There is something called the presidential cycle. And this is the stock market tends to have a pattern around presidential elections. And we are in year 3 of the presidential cycle, meaning we're in year 3 of President Biden's administration. And usually what happens in year 3 is that the president and Congress say, hey, we should do something to make ourselves look good to try to get reelected. And this is kind of crass, but it's true. And so normally there's some negotiation, maybe a spending bill, maybe a tax cut, maybe something, because both the president and Congress want to go back on the campaign trail. I mean, I'm using generalities, but assuming they both all want to get reelected, and they say something like, hey, look what we just did. It was great. And so there's a lot of motivation on both sides, even if it's different parties, to say we got to do something because we got to talk about something. We can't just be deadlocked. So usually the 3rd year of a presidential cycle is actually quite good for the stock market. And isn't that interesting that we are in the 3rd year of a stock market? And I just talked about how we may bottom this year and actually do well towards the second half of the year. Could it be because maybe politicians want to put up some numbers on the board? Yeah, could be. Usually the 4th year is kind of viewed as a dead year. And so stock markets is usually neutral. The 1st year of a presidential cycle is usually somewhat negative because there's a risk that a president and Congress may make changes, kind of buckling down. So when we look out kind of 2024, 2025, there's probably some risk there. But nonetheless, the presidential cycle is this year, and it may coincide with this idea of markets bottoming. These are great questions. So we're kind of coming at the top of the hour. So I want to thank everyone for your time. I know you guys are all busy. It means a lot that you guys are here answering great questions. If you're interested, we will have this as a recording. We are happy to send it out. If you are a client and you have any questions about your portfolio or what I've shared, we would love to schedule time to talk about it. We are always available. If you're not a client, we're happy to give you our opinion on how you're positioned on your financial plan. Happy to talk about our investment approach. If you're an advisor to successful families, we also would love to just hear about your business and be a resource to you. Again, thank you. If you have any questions, please reach out to us. Our general email is info@summithillwealth.com. Thank you and have a great day.